Welcome to the HC Commodities Podcast, a podcast dedicated to the commodities sector and the people within it. I'm your host, Paul Chapman. This podcast is produced by HC Group, a global search firm dedicated to the commodities sector. Today we're talking agriculture and the case for investing in agricultural commodities, particularly ETFs, and why that case is enhanced in the more volatile world we're in today and the perhaps much more volatile world we are in tomorrow. Our guest is Jake Hanley, Managing Director at Teucrium, a US-based ETF issuer with a specialisation in agricultural commodities. As always, please do leave us a positive review on the platform you're listening on. And as always, I hope you enjoy the episode. Jake, welcome to the show.
Thanks for having me, Paul.
So looking forward to the discussion. The genesis of this and sort of the root of it is around agricultural ETFs, the what, the why, the how, to some extent. But, to kind of get there and the thesis about why you and Teucrium think they're important, we've got some sort of background work to do on the state of the economy, where society is headed, and also sort of how ag's assets have performed historically in such events. I know at the moment you've been doing a lot of work on your market outlook for 2026, so we're going to kind of lean in on that. But can you just, I guess, without talking about ag specifically, can you just sort of set the scene in terms of yours and Teucrium's worldview at the moment? And, obviously from our shared notes, there's a feeling that we're at a pivot point.
Looking at the 2026 outlook, I want to take the opportunity to recognize that we're more than halfway through this decade. And I always look forward by looking back just to see where we've been. And back in 2019, actually, Paul, we were writing our 2020 outlook and had this idea that maybe the next decade of the 2020s would be a period of a resurgence in commodity prices. If you remember back in the first part of 2000s, we certainly had a bull market in commodities, culminating in 2008 with oil up in the 140s. And then, of course, we had that 2010s where commodities were really in a perpetual bear market for the most part. And so looking at the world shaping out in 2020, we had the impression that commodities prices would make a comeback. And boy, were we right for the wrong reasons. Of course, we didn't anticipate that COVID would take the world by storm and all the supply disruptions that went along with that. However, as the years have unfolded, in the last few years in particular, geopolitical conflict was certainly top of mind for us. Of course, in 2019, we were in the middle of a trade war with China, which has resurfaced. And so those types of concerns about limited resources, particularly in a world that is accelerating. The rate of change and growth is accelerating at a pace that we haven't seen before. We were writing about those challenges, and we are doubling down on that view. In 2026, outlook will be titled "The Great Acceleration," and that just has everything to do with AI and robotics and this new space race we're in.
Yeah. So let's stay at that 2019 moment. Can you just recap, I guess, the fundamental thinking behind, the commodity super cycle that was to come, right? And, there's a lot of sort of a lack of, there's a Jeff Curry sort of revenge of the old economy, a lack of investment, because commodities, moves in cycles. You have this really, as you said, very bearish periods driven a lot by the discovery of shale in North America, and low interest rates and so forth. That meant it was far better off doing financial engineering and sticking your money in a tech company that was in real world assets and stuff. Yeah, can you just tell us a bit about your reasoning there and kind of what the threads have been through to today?
Yeah, I think when you put yourself back into even that period slightly before that with the election of President Trump and that tumultuous period 2016, 17, 18, and 19, what became clear to me, and by the way, my background, I have a history degree. I studied U.S. history with a self-focus on monetary policy and history of central banking. And so I've tend to look to the world through the lens of a historian. And when you look back at other periods in history where you've had populist movements. In the United States, President Trump is a populist. There's no other way to say it. And the United States was dealing with populist movements on both sides. And
Goldwater, Huey Long, the list goes on, right?
Right. And so what I know from history in populist movements is that it creates a period of contention and stress, not only internally, but also internationally. Again, the idea with any populist movement is that you want to create the most value for your group. And in a world of fixed resources, that creates competition for resources. And of course, it's not just a populist movement inside the United States. We've seen this continue to play out in other countries as well. And so if you go away from the Thomas Friedman era of the early 2000s, where the world is flat and everybody's getting along and we can move everything, just in time inventory, to more America first or China first or France first, name whatever country comes first, you're automatically going to have instability and competition. And that shows up in the markets, which of course are a picture of the world.
Yeah, and you do have these very strong redistributive policies going on, right? I mean, even before COVID, but absolutely accelerated by it. That suddenly creates all of the inflation, which is, okay, it raises commodity prices. It doesn't sort of inflation adjusted. It doesn't necessarily. And then we kind of go through this period of financial tightening, reducing the money supply as a response to that inflation. That's how it kind of had a depressing impact on commodity prices. Today, we kind of, there's a lot of talk about blockchain and all that good stuff, but really it seems like AI is kind of, it depends on what your YouTube algo is, but it's mainly for me, AI, power consumption, technology sort of acceleration, as you point out. So that's obviously a key focus for you guys. So where have we been the last couple of years with obviously the drop off in commodity prices, and how is that going to change?
Yeah, well, how is it going to change? We can give you some ideas of how we think it might change, but of course, root that back in history. And so, another key element in looking backwards to look forwards is we talk consistently about something called the golden grain cycle. Okay. We'll use corn, but this applies for wheat and soybeans as well. So just tapping into agriculture for a moment. The golden grain cycle just points out very succinctly that there are three major points in a grain cycle. And actually this, I think, could apply to most commodities, but for corn in particular, if you pulled up a 17-year front month futures chart, and you can find it on our website, we update it monthly under the golden grain cycle. You can picture, Paul, that prices tend to move at or near the cost of production for an extended period. And the reason for that is that supply and demand are roughly balanced.
Definition of a commodity, right?
Right, exactly. And at the same time, especially in agriculture, production is subsidized. You have, crop insurance, federally subsidized, et cetera, et cetera. So farmers are going to plant. By the way, that's the same across the globe. No country wants their people to go starving. And so they make sure that farmers plant. They do what they can. And so prices are going to trade at or near the cost of production. Very seldom will dip too far below production costs because, of course, farmers are still going to need to make money. And that's stage one. And so if you think back to 2014, right through 2020, actually, those 6 years, corn prices, wheat prices, soybean prices basically moved sideways. Okay. Again, stage one. Stage two is when you have a supply constraint. Something happens. Typically for the grains, it's going to be a drought. So production fails to keep up with demand. And the world now is dipping into their excess reserves. Of course, on the WASDE report, we see then ending stocks. And so you're dipping into existing supplies to the extent that they're there, but next year's production isn't going to keep up. And so that puts upward price pressure. If you think back to the corn chart, corn went from roughly a cost of production national average of $3.50 a bushel to over $7, right? Even up to $8. So you're talking about a doubling there. All right. And that's happened 3 times since 2007 when we came out with the RFS standards. Um, that's stage 2, that when prices run up to the upside. Stage 3 is when production finally catches back up with usage and prices continue, begin to trickle down. That will take typically 1 to 2 years to get back to a stage 1 because, in the United States, of course, we have one growing season. And so it can be, and we've seen it since 2022, kind of a drawn out period where prices come back down toward those production cost levels. And so looking back again in 2019, as were writing that outlook, commodity prices generally had been trading roughly sideways. Certainly that was the case for agriculture. In our view, it was only a matter of time until there was some type of production issue where prices would go through that stage 2 cycle and advance rapidly. And of course, where we sit right now, we believe we are firmly in stage 1, with prices, trading at or near the cost of production. A lot of soybean farmers right now are selling at a loss in the United States. And so we do think that we are potentially at a level where there's very limited downside for agricultural commodities, which sets the stage for a potential stage 2. Who knows when that will come?
Yeah, yeah, and again, as you said, this is something that follows. Most commodities follow this. Many commodities follow this cycle. The cycle length, if you like, the whatever the correct mathematical term for that is, the period is obviously determined on how long it takes to turn around. So these, where copper mining, it's 13 years, right? Whereas ags, it's a season. Okay, so we'll put a pin in the golden grain cycle and that sort of thesis. Let's go back to just before we sort of talk about what's been going on in with regards to the ags ETFs and how they've been faring. Just a little bit more on your thesis at the moment and this kind of great acceleration you mentioned. Can you just piece that together for us?
Yeah, it's kind of tie that all back in. So the great acceleration thesis is simply that recognizing the fact that never in the history of mankind has the rate of change been as fast as it is right now. And think about what that means for planning and projections, capital allocation. There's so many varying forecasts even of what could potentially, come to fruition. You mentioned earlier just, AI and the electricity demand and the power that is needed to support AI. Well, if you look at forecasts from the IEA or Deloitte, they're vastly at odds with Deloitte, putting up something like 30 times growth in the AI data center um, requirement, right? So AI data centers are going to need 30 times more energy than they did in 2024. IEA's something much less than that. And so, is it going to be a 30-fold increase or is it going to be a 10-fold increase? And what does that mean for me today as a business owner, as a capital allocator? It's very hard to know. So with an uncertain future, that reflects back on uncertainty in today's markets. So I keep hearing, I spend a lot of time listening to agricultural media, as you can imagine. And a repeating theme is these farmer types or commercials that are coming on saying, we just want some certainty. We just want some normalcy. And every time I hear it, I have to scream, it's not coming back. I'm sorry, but you're not going to get it simply because the accelerated rate of change is historic and it's not anything that we're used to. That's going to continue to create consternation, obviously for individual allocators and business folks, but for nation states and for everybody around the globe. Understand that private markets, private business, and capabilities are expanding far faster than the regulator's ability to keep up. And that is something that's going to create opportunities, of course, to make a lot of money in new fields, operating in sort of a Wild West environment. We can just look at crypto markets as an example of that. But of course, that could create significant instability across capital markets. And so we are in this period of heightened uncertainty. I'm going to suggest that volatility is always bubbling right at the surface, ready to jump. And so that's just a reality that we're going to have to work with during this period of this great acceleration.
The energy and resources sector is experiencing unprecedented change. To help navigate this change and capture its opportunities, HC Group launched Enco Insights, a global advisory network dedicated to the sector, providing senior advisors and subject matter experts to investment and infrastructure funds, law firms, and corporates. Enco Insights leverages HC Group's 20 years of connections in energy and commodities to give clients the expertise they need when the stakes are high and insight matters. Learn more at encoinsights.com.
We have covered that volatility stories. And actually, in a year where volatility has died down, ironically, in commodities, despite all the events that have happened, but kind of whether it's cyclical or whether it's structural. And there's certainly pieces there that government intervention and so forth, and sort of increased geopolitical tension. But I guess what you're leading into there is what we've been describing as digitization, kind of from a small lens on the commodities sector, right? How that's impacting the efficiencies, how that's impacting decision making, and breaking down some barriers to entry and raising up others. It's kind of fascinating, actually the digitization, the technology piece. That's the bit that's really accelerating. That's exponential, as I'm stealing this from your notes, right? Versus the linearity of policy making, which is almost ground to a halt and isn't even linear anymore, right? It's horizontal, and the response to that rapid change is kind of is government intervention, right? Is sort of fingers on scales and so forth, because hell, we need a critical minerals sector. But it's also kind of the huge pressure to open up to alternative investments, to unaccredited investors, and all that. There's so much kind of going on that you point out that in and of itself, where it's AI, robotics. Yesterday Amazon came out and said they're going to do away with 600,000 jobs by the end of the decade in their warehouse, right? Just going to make, absolutely profound changes occurring, some positive, some negative. That itself is going to create so much volatility, driven by policy, driven by reaction, all this kind of stuff. Where does that, just staying on ags, right? What does that mean for ags? Have we seen it? Because unlike, say, the renewables sector, which is a technology, not a commodity, right? Which often I think gets kind of missed. Ags in particular is it's pretty finite, although yields have been going up. There's only so much land that can grow various crops, climates. There's lots of restrictions there. So what's the thesis about agricultural commodities and why ultimately you should own the ETF kind of thing?
No, yeah, sure. Well, we can't give financial recommendations or advice.
No, of course not. No, but yeah.
I'll stay away from saying you should. But what I can tell you, the conversations we have with investors and around this very idea. So, corn, wheat, soybeans are grains lumped together. Technically, I have one client investor who always points out, soybeans are actually a legume. I say, yes, I know, but we're going to refer to them as part of the grains. Okay. These products are primarily used across the globe as feed for animals. And it's funny, in the United States, not everybody gets that. We understand corn for ethanol, but just a general investor with whom we deal with who's buying ETFs, not necessarily trading a commercial futures account. They go, wait a second, corn's used for animal feed? Well, yeah, that's its number one global use. And
in China in particular.
In soybeans, right? And, you look at, even as the rest of the developing markets, in this, it's a study I haven't looked at in a little while, so I won't give you the exact numbers, but the basic idea is pretty simple and I think widely accepted. And that is, as societies moved from sustenance living, where you're in the bottom, quintile of income, and you get a little extra money in your pocket, one of the first things you do is increase the animal protein in your diet. And so that certainly we saw play out, in China for sure, with the world's largest hog herd. Okay. And so as economies continue to develop and people are making and earning more money, they are going to continue, I believe, to consume more animal protein. And so that creates a natural demand for grains. And we can see that as you look at the WASDE report, the USDA, when the government is open, we'll put that out monthly. And you can see that the grain demand continues to march higher. And so that idea of sort of perpetual demand growth, there are years where you'll dip a little bit and then the next year will be another record. It really underlines the entire thesis for the grain commodities. Somebody looking at it as a long-term investment, however, will say, well, hold on a second. Jake, you just said for 6 years, corn moved basically sideways. There's an opportunity cost I'm missing on other investment opportunities if I, buy and hold something for 6 years and I got to pay fees, but it doesn't go up. So what's the real benefit there? In that standpoint, our conversation for those types of allocators is, look, if you're looking to buy and hold for a longer period of time, you have to look at the historical correlations and potential diversification that agriculture can serve inside of a portfolio. And a lot of the direction that we're going to take in talking about the great acceleration is resiliency. So you need to have resiliency as you're thinking about your investment portfolio, just as I hope policymakers are thinking about resiliency as they're reshaping the world in trade negotiations. Okay, that resiliency comes from having assets in your portfolio that zig when others zag. I mean, this isn't rocket science or anything new for the audience, but understand that corn, wheat, soybeans in the ETF package can help provide that potential diversification benefit, as well as perform well to the upside when you get into that stage 2, right? When there is another supply or production concern.
We just had Mark Crandall on. Although at the time of recording, he hasn't come out. But yeah, by the time people hear this, Mark Crandall will have been on for 2 episodes, one of the founding fathers of Trafigura and instrumental in Mark Rich in the early days and so forth. And he talks about how like the natural setup of a lot of these commodity flows is that on a day-to-day basis, they don't make any money. They often lose money, but you're there to capture these events, right? And they're anti-fragile in the Nassim Taleb phrase in that sense. Although he'd probably dispute that, blah, blah, blah. But, just taking that, I kind of, you go back to the kind of world that we're in today, right? And lots of discussion around whether risk premiums are really, wheat goes down after, invasion of Ukraine. Oil goes down after the US bombs Iran. I mean, like, it feels like there's sort of the true risk premiums aren't or they're being discounted at the moment, considering how volatile the world is. And then, well, let's tackle that. And then I want to tackle like how you start dealing with the world of increased government intervention. And as you've already pointed out, food is absolutely ground zero for any government. It's food and shelter, right? And if governments get the food bit wrong, they quickly are no longer governments.
Yeah, absolutely. So, it's interesting that idea of bombing Iran and watching oil prices not react. I mean, it's shocking almost, but I can't speak to that specifically because I don't cover energies as close as I do the grains, but I can talk about wheat and the war in Ukraine and perhaps the lessons that I learned there in observing that conflict and wheat in that period apply to energy markets right now, and as it relates to the strikes on Iran. And that was simply, it was somewhat telegraphed in that, okay, we wrote about it in our 2022 outlook. In 2021 at the time, we said it looks like Russia is getting ready to mobilize an invasion of Ukraine. And of course, Jen Psaki was the press secretary at the time. She said in January, it's only a matter of time. And yet when the missiles started to fly, the tanks started to roll, the troops started shooting each other, wheat prices did, Paul, spike. And so in that early part of the war, we saw wheat prices jump and make new highs eventually before coming back down. And I point to that because we wrote about it. Obviously, the White House was warning about it, and yet the wheat market reacted as if it was surprised. It was one of those moments where, I truly believe that the prices are a scoreboard and reflection of reality and what's going on in the world. Okay, that's just, it makes sense to me. And so I would think that if Russia's really about to invade Ukraine, should be showing up on the board. Well, it wasn't. And so it made me scratch my head. I said, well, maybe they're not going to invade Ukraine. And maybe, what I'm reading is wrong. Well, boy, oh boy, they did. And they surprised the market. I can say that because wheat prices shot up. Now, to your point, wheat prices came back down. I mean, they peaked in 2022 and have basically been moving lower ever since. And the reason for that was, and remember, this about 30% of global wheat exports come from the Black Sea. So there was a significant, crisis unfolding at that time. But the reason wheat prices came down is because the wheat was still available. And fundamentally, when your supply can meet demand, or at least the market anticipates that it is likely to do so, that is going to put pressure downward on prices. And that's exactly what happened. It took a little while, but the Ukrainians are very resilient. Europeans helped out. They started moving wheat westward over rail almost immediately. What took a while was getting the grain initiative signed, with the help of Turkey and negotiating the Black Sea corridor. And so grain continued to move through the Black Sea. Some of it was going up the Danube, again, moving west. Now, that's the reason wheat prices came back down. It was the fact that wheat could still get out. The initial reaction was, oh my gosh, 30% of the world's wheat exports are coming offline. That didn't happen. And so with striking Iran, maybe that's the thought of the energy markets too, saying, oh my gosh, this is a crazy event. Oil should be spiking. But looking at the reality of the situation, there's enough supply, that we didn't have to necessarily worry about bombing Iran.
I think you're right. I think it's also that you've got a lot of mean reverting algorithms out there as well. There's incredible pressure to, those things start whirring pretty quickly when prices spike. One more piece is to get in, and so then you've got this world of increased government intervention. You've got the fact that food is central. No politician gets re-elected if as inflation is so profound, right? Although note today's CPI numbers don't include food and energy, which are basically the two things that are going up. That helps. That's a story that's global, not just local. How does owning exposure to agricultural commodities, how are they robust to tariffs? Are they is the fact that the fact that the government's always going to come and subsidize farmers, obviously it's a key political story at the moment in Washington over the fact that China isn't buying US soybeans and has an impact on markets isn't that a constant downward pressure on prices?
Yeah, it's a constant downward pressure on prices for the simple point that we subsidize production. So when you subsidize supply, you put downward pressure on prices. When you subsidize demand, you put upward pressure on prices. This is why healthcare costs go up. This is why, tuition costs continue to rise. We subsidize demand in those sectors. We subsidize supply when it comes to food. And so those policies act as a natural lid for prices until there's those supply shocks. And again, historically in the grains, it's been weather related. The other side of it with tariffs and trade policy, that can create backlogs that simply have to do with finding new customers, new logistical routes to deliver the products to the buyer. And so, this tariff war, the trade war that we're in with China, obviously it's hurting American soybean farmers in a big way right now. However, again, if you look at the reality of the WASDE, there's another 74 million metric tons of soybean importers out there somewhere, and the United States only needs to sell 44 million metric tons, somewhere around there, according to the September numbers. And so there is another market for the United States to market to. Fundamentally, that's supportive, I believe, for U.S. soybeans. It's just a matter of time of finding those markets. And so I would say that, yes, policy is always going to need to be consideration for commodities, well-regulated markets where you have all these considerations. But fundamentally, for soybeans in particular, there's an opportunity to sell into that demand.
Hello, I'm David Hunt, founder and managing director at Hyperion Search. Founded over a decade ago, Hyperion Search has helped organizations from major utilities to startups recruit their leadership teams and key individual contributors to accelerate both their growth and the energy transition. Our three main verticals are renewable power, energy storage, and e-mobility. The energy transition and the talent that delivers it has been our passion since day one. To find out more, visit hyperionsearch.com or listen to my Leaders in Cleantech podcast, available on all platforms.
The one question I still don't really get my head around this, and I know, and I get told sort of, there's sort of benefits to the role and all this kind of stuff. Obviously, the one great thing about, or traditionally the one thing about owning a stock was it produced a yield, the value was based on that yield, and you got the benefits of compounding interest. When you hold a commodities ETF, it's just purely, correct me if I'm wrong here, and I think I'm wrong, but ultimately you're just exposed to the price of the underlying commodity, and you're not benefiting from sort of the role and any other. Is that right?
Well, so that's interesting. We can get into the structure of our funds to speak to this point. Agricultural commodities are typically in contango or a carry market. And that's the idea where the cost of carrying the product month over month, you have your insurance, you got to keep it dry, et cetera, et cetera. There's costs to carrying the product. That's built into the curve. And so take the soybean ETF, for example. That is based off of our proprietary benchmark, where we hold the second to expire contract, third to expire contract, and then the November following the third to expire contract. So as of today, SOYB, SOYB, holds January 26, March 26, and November 2026. Now, and actually let me pull up the curve right now just so I can speak intelligently to this. You have, come on, there we go. Right now you have January 26 at 1062. We're going all the way out to November 26 at 1080. So you are in a carry market. And what that means, Paul, is that as we sell the nearby contract and buy the further dated contract, right? We're never taking delivery of soybeans, God forbid. Okay. We're paying, there's a negative roll yield in that because we're selling relatively low and buying something at a higher cost. So that negative roll yield does weigh on the fund's performance over time. So that is something to keep in mind. Our funds were designed to hold three different contracts and go out across the curve for the reason that we wanted to help mitigate that negative roll yield when it's there. If you think to the very first generation commodity ETFs that came on the market, something like oil, the popular oil ETF held 100% of its holdings in the front month contract.
Yeah, and just got sold against it, right? Like
over and over and over again, you had a transition, there's 12,000% turnover or 1,200% turnover. And, if you're in a contango market, that's really going to weigh on the performance. So with soybeans, corn, wheat, we roll roughly a third of the portfolio 5 times a year to rebalance to the benchmark. And of course, the opposite is true. When the curve is backwardated, it can work to your advantage. And so you can capture that powerful.
Exactly, and different indexes are, depending on sort of how aggressive the salesperson is, will tell you different things, right, or whatever, or how proud they are of their index. But essentially, you're making a bet, and you want to make the bet, or you want exposure to the underlying commodity prices, and the kind of there are very, very well known ones in energy, and I guess the point here is that when you look at the agricultural sector, you've got there's nuances, there's difference, there's criticality, there's not the same technology kind of disruption that is currently happening in energy to some extent, but also we know that in volatile times, in periods of stress in the global economy, agricultural prices shoot up, right? So you look at what happened in the financial crisis. Obviously, then you subsequently had the Arab Spring. You look at what happened during COVID. you're seeing significant run-ups in the value of a basket of corn or soybean or whatever it might be. Is sort of the general sentiment, if I'm not wrong. And the argument is like, hey, you could look around the world today and say, we're, far from things kind of returning to normal like prices might suggest, it seems like we might be on the cusp of quite some disruption.
Absolutely. And so if I'm looking at managing a strategic portfolio for an institution or an individual retiree, I'm going to have some exposure to commodities, and I'm going to diversify that commodity sleeve to include agriculture, because even though you have all these broad macro stories that can tie into each other, the truth of the matter is, as you point out, Paul, energy is different from agriculture, right? Each of these commodities does have its own fundamentals that it's going to march to. And what's impacting the soybean market right now is not exactly the same narrative that's impacting the corn market. And so having that diversification can potentially help long term, I believe.
Yeah, and there's a couple of pushbacks I have, and I accept. Was it John Maynard Keynes that said, "In the long run, we're all dead"? So some of these might not apply, but have certainly come up, right? So one would be when I talk to our clients and colleagues and friends in the agricultural sector, and you take the long view, it's absolutely astonishing, particularly in the US, but how modern agriculture has increased yields dramatically over the last 50 years, right? So, and without that, you could imagine a world where, well, that's why we have such cheap food and such massive plates of food here in the US in particular. So that's one deflationary aspect. Can you sort of talk to that a little? Is there sort of any thesis that we're kind of starting to get to the maximum we can do with the modern technology?
Maybe. I don't typically talk about scarcity as it relates to a linear time frame. And what do I mean by that? So, are we coming to a point, I think, Paul, what I read into your question is, where we're not going to be able to produce enough food anymore?
No. Let me sharpen my question, which is one of the deflationary aspects of owning agricultural commodities is that every year, despite weather impacts and all the rest of it, yields seem to continue to outperform and impress. In other words, the application of molecule level editing, plant support, all this piece, with combined with modern technology, combined with sort of industrialization, has meant that yields continue to go up. And my point just being, 10 years down the line, have we doubled the amount of soybean we get out of a particular acreage, and you just can't overcome that deflationary pressure.
No, I see what you're saying. So yeah, will the production supersede demand permanently? So where you don't have these massive price moves from time to time. The answer is yes, that is absolutely possible. But I would say that there is still a market function which will balance that out. And that market function will show up in a couple ways. One is finding new uses. And so we see that with biodiesel and things of that nature. And the other side of the function is lack of demand will eventually mean, well, we don't have to spend as much money subsidizing production anymore. And the market will balance in that way. And so I don't see an end to what we've, come to see from time to time again, which is you have a growing surplus and bumper crops from year over year. And then you have, boom, some type of supply and production shock where you're dipping into those excess reserves. And then you got to rebuild those supplies again. I think that's just natural for any commodity market. And to the point where we can get more and more production, well, that's a good thing. It might have something to do with land values. If you want to talk about, where those impacts could show up, they could show up on farm land values. But I just would see a self-correction, again, either by demand or lack of additional subsidies. Yeah.
And then this is probably way outside the purview of an investor's lifetime, but we had Todd Thurman on an episode talking about depopulation. He's I don't know if you come across him, but he's interesting to follow on LinkedIn. He's an animal livestock economist and spends a lot of time in China and his sort of thesis is that actually, depopulation or population decline is going to happen sooner and more dramatically than certainly the UN predicts, and probably as society is anticipating, and that will have a profound impact on agricultural commodities. But again, that's 2080's problem in some senses, or 2060's problem, rather than the next 5 years.
Thanks for mentioning him. I'd like to look into his thesis there.
Well, you can listen to an episode of the HC Commodity podcast.
Oh, good. I'll make sure. I'll start there, Paul. Thank you.
Yeah, if I was more prepared, I'd have that episode in it. But if people just search back, you'll find
Right.
Todd Thurman. It's a great episode.
All right.
Yeah, and by the way, there's another YouTube rabbit hole for you. Is China population and all of the various efforts by hedge funds and investors and all the rest of it to pick apart cell phone usage data and so forth to try and get a better estimate, because obviously it's a profound commodities story if actually their population isn't as big as they say it is at 1.4 and is perhaps declining more quickly. But anyway,
Wow.
Right?
Yeah. Good.
Okay, so great stuff. Just one final piece, and now I kind of want to move on to just a little bit about sort of the future and what keeps you up at night. Is there you've got various ETFs, corn and soybean focused. How do the dynamics between the different agricultural commodities play out? As you say, they have very different roles in the food supply chain. Is there any difference there when it comes to kind of that macro story about owning them in times of volatility and crisis?
That's a good question. When we're conducting research and writing our commentary, it really is for that retail investor audience who doesn't necessarily have a sophisticated background in these markets. And so we will point to some basic differences around trade partners, for example. China is critical for the United States soybean exports. They're important for corn, but they're not critical, right? So there's other markets there. When we talk about wheat, we usually just point out to the fact that wheat is grown everywhere in the world for the most part. Wheat is biblical. Wheat is geopolitical because it's grown everywhere in the world, and because it is human food. It's a very sensitive topic, and so the types of things we cover as it relates to wheat are different than from corn and soybeans. But generally, when you look at the function of these ETFs inside a portfolio, they have very similar behavioral characteristics, low correlations to stocks and bonds. They all follow the golden grain cycle. And so for an investor who is going to pick one over the other, it truly becomes a narrative surrounding that commodity. So in 2022, our ticker WEAT, wheat, took in a lot of money relative. I think it had $300 million in it before the war started. And in 4 or 5 sessions, we were up to $700 million. That was a big day for the wheat ETF. For corn, go back to 2019, where we had some flooding in Iowa. Corn prices, went up 10, 12, 13%, whatever it was at the time. So money came into the corn ETF. And even right now in soybeans, we've seen some money trickling in, I think, as people are trying to position in front of the US-Chinese talks that hopefully do happen coming up, I believe, just next week. And so there are different narratives surrounding each one, but from a functional basis inside of a portfolio, there's a lot of similarities.
Yeah, fascinating. And, you have to hope that as we record today, the US-Canada talks are off because Canada repeated some words of Ronald Reagan. So it's even the talks alone are volatile these days, right? Whether they're going to happen or not. But I guess the one sort of question, and it turns out that in our notes here, you mentioned Neil Howell, and I've actually got Neil Howell's book in my Audible queue to listen to. It's been there for a year, so this will spur me to read it. But I guess there's kind of like, and this is outside the purview of a podcast on the commodities, but there is a certain amount of which there might be a tipping point in the amount of disruption that's coming, driven by technology, driven by populism, driven by a whole technology that's driving populism, I would argue, and then the response of legislators or lack of versus society to that massive, profound and rapid change, there's a sense that actually you could reach a tipping point where some of this stuff starts to become quite dangerous indeed, and it might be good if your ETF still, the markets are still functioning and so forth. We all have very different problems if they're not. But can you just, I guess, without, it's sort of Halloween time.
Not be too scary.
Yeah. Well, I mean, what is the Neil Howe thesis on this?
Oh, so Neil Howe it talks about turnings, and the name of the book is his latest book is The Fourth Turning is Here. And so the basic framework there, and by the way, I mean, mental models and frameworks are helpful, but they are just that. They are only frameworks. And what I find interesting about this framework is that Neil Howe looks at demographics, and really he's looking at generations and how every 4 generations, call it 80 years or so, that cohort typically replays itself. And so I don't have the book right in front of me, so I forget the actual names he gives to each generation, but there's a generation of people who are very community oriented, right? They've been through some tragedy at some point. So they're in the first turning where they're rebuilding society and they all work together. And he would point to the 1950s, right? Coming out of the Great Depression and World War II as kind of being that generation. And then from the first turning till the fourth turning, you get a little bit more rebellious, right? So, the kids don't listen to their parents, and then their kids don't listen to their parents. And everybody's got to go figure out something for themselves. And eventually it all breaks again. And that fourth turning is when everything breaks. And based on his framework, he pointed to, and they wrote Strauss was the co-author's name. I believe they wrote their first book in the late 90s. They said somewhere around 2008 would be the beginning of the fourth turning. Well, okay, so we had the great financial crisis in 2008. And they also posited that the end of that fourth turning would be somewhere in the, between 2025 and 2035. And so right now, Neil Howe is saying it's roughly 2033. The end of the fourth turning just means you've gone through this ultimate period of maximum crisis where everything has broken to pieces, and all that is left to do now is to start putting it back together. And so that framework.
Fun times ahead. I wonder if he anticipated the fact that the first generation, all those 80-year-olds, are still clinging. I mean, a gerontocracy is a pretty good way of describing the certainly United States politics, but actually global politics when you look at who's in power, and maybe there's I don't know, some of them are still hanging around. But okay, well, our first HC Commodities podcast book recommendation is we'll go read The Fourth Turning and not get too scared.
Yeah, I would read that one. I'd also make one more book recommendation to read True Believer by Eric Hoffer. It's about mass movements and mass psychology. Fascinating read.
Okay.
Yeah.
Well, I'll add that to the Audible queue.
That's a shorter book, by the way.
Okay, great. Well, Jake, it's been a real pleasure having you on, actually, and look forward to hopefully having you back on in a year or two where you can tell us how boring the world's been, and I know probably not good for business, but the ETF has been calm and stable. But we've covered ETFs in oil and getting energy. We've covered ETFs in power. So it's kind of been great to get a look at the ag side, and kind of plays back to some of the episodes we've done, war and wheat and so forth. So thanks for coming on, and I hope to have you back on in the future. And I'll put links to Teucrium and your ETFs in the show notes.
Thanks a lot, Paul. Appreciate it.
Thank you for listening. To find out more about HC Group, our global offices, and our expertise in search within the commodities sector, please visit www.hcgroup.global.